Hello everyone. Today we learn about index futures, the center of the financial markets. E-mini S&P 500 ES, E-mini 100 NQ, and the micro E-mini NES are contracts that institutions and active traders around the world trade every single day. In the textbooks, these futures are known as a fast way to respond when big capital needs to move quickly. By the end of today, you'll clearly understand why small cash can control a huge position and exactly what you can lose in return. An index future is a binding promise to buy or sell an index level on a set date. Unlike an option, you do not have a choice. You must fulfill the contract. For example, if the S&P 500 cash index is near 5,500, a September futures contract might trade at 5,510 or 5,490. When the farther contract is richer than spot, we call that contango. When it is cheaper, backwardation. Look at the chart and compare cash versus futures yourself. The key idea here is margin. Looking at the live ES price on your screen, you typically post only about 5 to 10% of the full contract value as collateral. That ratio moves with your broker's rules and with market volatility. That is leverage. It feels like magic, small cash, big exposure, but losses grow by the same multiple just as fast. Looking at NQ on the screen, let's compare the size of 3 index futures you can actually trade in the US. E-mini S&P 500 ES 1.2 equals $50. At an index near 5,500, the notional is about $275,000. Yet you can often start with roughly $15,000 of margin. That is about 18 times leverage. E-mini Nasta minus pay NQ 1.2 equals $20. Near 16,000 on the index. Notional is about $320,000, with margin often near $15,000, roughly 20 times scale. Micro E-mini S&P 500 MES 1 point equals $5, 1/10 of ES. Near 5,500. Notional is about $27,500, and margin is often around $1,500. Same leverage math, smaller tickets. One critical point. Yes, these are retail size versus the old full-size contracts, but you can still wipe out an entire account in one bad move. Smaller does not mean safer. Looking at the ES weekly chart, let's talk about the most dangerous part of futures, forced liquidation, the automatic stop-out. Everyday analogy. You put down a $1,000 security deposit on an apartment, your margin. Damages cost $500, your open loss, so $500 is left. The moment the landlord requires a $600 minimum, your lease is canceled automatically. Concrete case. You buy ES with about $12,000 of margin. If the S&P 500 drops 200 points, that is 200 times 50. A $10,000 loss. Roughly $2,000 of margin remains. Keep falling until equity slips under maintenance margin, often cited near 70% of initial, depending on the firm, and your broker can flatten the position for you. The problem is timing. It can hit while you sleep or during a crash. If the exit is a market order instead of your preferred limit, the loss can be far worse than planned. That is why people say forced liquidation fires at the worst possible moment. Every major futures crisis has repeated this pattern. The same futures contract looks completely different depending on why you use it. Hedging is insurance for a large portfolio. Say a fund holds about $10 million in U.S. stocks and sells ES futures against them. If the market falls, futures gains can offset stock losses. Speculation is different. Put up about $12,000 by one ES, and a 200-point rally is a $10,000 win, about an 83% return on that margin. The reverse move is the same 83% loss, and worse is possible. Historically, big shocks, the 2008 financial crisis, the March 2020 crash, triggered waves of forced liquidations. Retail traders who were not watching their accounts got auto-closed, sometimes within seconds of each other, and losses ballooned. Bottom line, hedging is insurance. It costs but caps damage. Speculation is high-risk trading. You can lose the whole stake. Define your capital, watch time, and max loss before you start. In futures, the smallest price step is a tick, like a stock quote that moves a penny at a time. US, 이민희 S&P 500원 틱 20.25포인트. Watch the chart. Every move from 5,500.00 to 5,500.25 is exactly $12.50 per ES contract. 4 ticks make 1 full point $50. So 0.25 times 4 equals 1. The math checks out. NQ, Himinina, 100 also a 0.25 point tick, but the dollar value differs. 1 point is $20, so 1 tick is $5 of P&L. MES, micro E-minute 500 same 0.25 point tick size as ES, but 1/10 the value. 1 tick is $1.25. Finer for small accounts, still real money. These tiny moves stack into hundreds of ticks a day. Algo traders fire on single tick edges. Your gains and losses accumulate surprisingly fast. Try tracking second-by-second moves on the chart yourself. Quick wrap. Index futures are where institutions hedge whole portfolios at once, and where markets react instantly to Fed rate decisions, inflation prints, and other global macro signals. ES, NQ, and MES are the workhorses. The upside is clear. Margin lets small capital control large notional. The entry bar is lower than old full-size contracts, and trading hours are long, nearly around the clock, so global news hits these charts fast. But the point I want to stress, that does not mean cheap, it means dangerous. Forced liquidation, volatility, and macro shocks can erase a position in one hit. Before you trade live, you must be able to answer enough capital, a clear stop plan, and exactly how much you can afford to lose on this trade. Next lesson, we cover option Greeks and finer hedging tactics. Today's index futures basics are the foundation. Trade safely. Please scarlight this lesson is educational only, not investment advice.